Welcome back to the Educated Home Buyer Live, where we answer your mortgage and real estate questions live here. We have some fun in the process. Last week we were off. I actually had some parental duties, some spousal duties. It was my kids' spring break, so we took some time off and enjoyed the desert. Therefore, we miss some important data that came out, Josh, and that was inflation data. Inflation actually came in a little bit better than expectations. In fact, you and I were messaging back and forth a couple of days prior to that, maybe even the day before, talking about how this could go sideways. Based on some of the reports out there, it looked like inflation might come in a little bit hotter than expected. Fortunately, it did not. And we actually saw a little improvement in rates. Since then, we've given back a lot of that. We've seen a sell-off in bonds. We've seen yields push higher and rates push higher. And here we are back again on the show. Josh, welcome back.
Yeah, welcome back. Welcome back to you, buddy, from being back from the desert. You golfing, hanging out,
I
doing
was not
kid stuff,
golfing.
what
I
doing
was
having
not
fun.
golfing. I was just enjoying warm weather, which we have not had here in Southern California in quite some time. So I was taking in the 90 degrees, the 100 degrees, like nobody's business. It was all good.
I got to wear shorts today without freezing, so that was a good first step here in a while. Going back, Jeb, to that data, there's not a lot of common sense going on in the market. One of my favorite bond market analysts basically said 2 days ago, this is completely illogical. All of the data is pointing towards things improving. We had a big breakout about a month ago. I forget what it was that caused that, but it was the banking crisis. There we go. The short-lived, long-forgotten banking crisis, and we saw the 10-year go from up in the 4% range down to 3.23, 3.24. And now we've settled into a range between 3.4 and 3.6. So until the market gets some additional data that confirms that lower range under 3.4 is the new and preferred and validated range, or more data that says no, inflation's still problematic and we need to go back up above that 3.6 range, we're just likely to go sideways. Now, Jeb, we're a week, 8 days past the CPI data. So we have about 22 days before the long awaited April, released in May CPI data, where we think we're going to start seeing moderation in housing. There's major issues with how the government measures inflation for housing, owner's equivalent rent. Just there's a couple things that are funky about it, but the way that it's measured, it's a very lagging indicator. We're not seeing rents come down, but what we're not seeing is this time last year, rents were still massively accelerating, double-digit year-over-year increases. Now they're relatively flat, so that should start feeding into the data, should improve the inflation outlook. Big picture, Jeb, the one that we have to be looking at that really, if we're to boil it down to one thing for us to look at going forward, it's employment and how that relates to services inflation.
Mm-hmm.
The people who think inflation is problematic and not going to be controlled and going to remain elevated are pinning their thoughts on core services inflation, and services inflation remains elevated. That housing component is a piece of it. It's technically a service. The biggest part that we're looking at that is the confounding variable there is employment. So the Fed wants to have 4.5% unemployment. What do we have, like 3.5, 3.6 now, Jeb? I don't remember what the number is.
I think we're still at 3.5.
3.5. So they want it to be a percent higher. That's a pretty significant move. That is a lagging indicator. We've talked about all the recessionary signals, not just the inverted yield curve, but all sorts of numbers, manufacturing numbers down, everything except for employment. But employment generally lags. It peaks right about the time recession is starting. So when we see that going forward, we saw services inflation was pretty steady prior to COVID. It dipped when all of the people got laid off. Everyone in hospitality, tons, massive, millions of layoffs. So we had no inflation there. Now getting those people back to work and back in the workplace has been somewhat inflationary to the cost of services. And that is the one we want to look at going forward.
No, absolutely. Just turning my phone off here so it doesn't beep. So, we don't have, as many of you guys know, the Fed meeting this month in April. So our next meeting, I believe, is right after the right after the CPI numbers get released on May 10th, I believe is the date. Is that right, Josh?
I
May
haven't
10th is the
even
date
looked.
for, and then the Fed meets shortly after that. So what you're going to see, or what you're likely to see, I mean, we saw the 10-year today. Josh was talking about the range earlier. He didn't really talk about what he was talking about when he said 3.4 to 3.6, but he's talking about the 10-year, right? And so we've seen the 10-year bounce around between that 3.4 and 3.6 number. It actually went above 3.6 today for a good portion of the day, and a lot of it had to do with things happening overseas with regards to inflation. So because we don't have data coming out in the US at the moment, bond traders are now looking overseas at inflation data, and that's starting to play, on the market. But at the end of the day, it didn't hold up. So you've got, the market is looking for no volatility, right? No volatility essentially is a calming for the market, and in turn would allow interest rates to likely move down. But as long as you've got volatility in the market, the unknown in the market, you're going to have this bouncing around. And that's essentially what we're seeing now. I mean, Josh, you and I were having a conversation earlier in the week. In fact, last week we were talking about 30-year fixed rates being in the low 6, high 5% range for some borrowers. And you and I were talking about numbers this week, and you gave me a rate at like 6.75. And I was almost shocked when you gave it to me because of how quickly those numbers changed in the matter of a week. So with that said, I know we're going to talk about inventory. We're going to talk about some of this stuff, and we normally end by talking about rates, but let's start today by talking about where rates are at the moment.
Do we want to throw our slides up on the screen?
Yeah, let's throw them up.
So let's do that, because I put an interesting, Jeb, I noticed this is a service that both you and I subscribe to, and I didn't realize that they do a wonderful job of capturing the three primary reports. Mortgage News Daily does a number, Freddie Mac does their weekly number, the Mortgage Bankers Association also throws out a number. This is a good place for us to start. So Mortgage News Daily is reporting 6.75 on the 30-year fixed. You'll see updated yesterday. 15-year about 0.5%, a little more than 0.5% lower than that. FHA at 6.25. That's kind of a crazy number. You should be under 6% if you're on an FHA or a VA. They have both of those at 6.25. Freddie Mac, that information's a week out of date, probably was 6.25 a week ago. MBA data is at 6.43. I would look most closely. That Mortgage News Daily information is pretty good. What I would generally say, it's relatively accurate, and you can probably do better than that if you shop a little bit. And if you're seeing something massively different from what Mortgage News Daily is reporting, either to the high side or to the low side, I would ask some questions, because they're generally a good middle of the road number to look at. So does that give you the range you were looking for, Jeb?
Yeah,
Probably.
I think it's good. It's, and something important to note here, again, having that conversation, don't just look at these numbers and think that's what rates are. Josh mentioned some of these numbers are a week old in how they're, reported, reflected, or what have you. So make sure you're having that conversation with a lender. And, you were talking to some borrowers yesterday that you helped pre-approve, I don't know, 4 months ago. Actually, it's been longer than that now, I guess. And the last rate you were talking to them about was in the 4% range somewhere, and now they're talking about rates in the 7% range. So that's a big shock to those potential buyers with regards to the monthly payment, because you're talking about a huge increase in the payment. So if you're out there shopping, just make sure you're having these conversations on a routine basis, just to make sure you're updated with everything going on. So let's back up a little bit here and start at the beginning, which is of the slide deck here. Are you touching it as I'm touching it?
No, sir.
Okay.
Let me get back to slide number 1 for you.
There you go. All right. So we normally start off by talking about inventory. Inventory continues to be the main reason that we're seeing price stability in the market, because it's not like you're seeing a huge increase in demand. Demand is more or less staying pretty stable. But what's driving a lot of the prices, a lot of the craziness in the market, is just the lack of options, the lack of availability of inventory. And as we can see, we're sitting at 405,000 homes nationwide, which is a decline of about 5,000 homes from where we saw last week. And we can actually see that reflected in how new listings, right? So new listings are increasing, but not at the pace that we've seen over the last couple of years. And because we're not seeing new listings come to the market, we're seeing inventory continue to to move sideways, to move down in many markets out there. And I didn't talk about this, but let's go back. Orange County sitting at 2,043 homes. This is about where we were 2 weeks ago when we were talking about inventory levels. The crazy thing is, since then, I've seen inventory levels go below 2,000. I actually saw them at 1940 something for a little bit, and I thought, oh my God, this is crazy. And then I saw them start going up 2,100-ish. But those were homes that came on the market and immediately went into escrow for one reason or another. So you're kind of staying in this range. And understand, inventory typically increases gradually, like at a small pace between January and March. It's kind of just slowly comes to the market, inventory starts to build. This is when you start to see inventory pick up a little bit, and we're not seeing it, guys. We're not seeing the normal jump in numbers like we normally see, which is a bit concerning because it's going to start to reflect in some of the numbers going forward. So of the properties that are on the market supply-wise, 31% of the homes are new construction. So that means if you're in a market that has a lot of new construction, a good portion of your inventory is that. I would think here in Orange County, we're not 31%. We're not even close to 31% being new construction. I would say it's probably less than 5% just because we don't have a lot of building here. But nationwide, you're looking at 31% of the homes. And I think that's still where your opportunity lies if you're looking to buy a home, if you got communities that have a lot of new construction, because again, you're going to see new construction continue to build inventory wise through the year, probably peaking sometime in Q3 based on the reports out there. I think there's something like 743,000 homes, single family homes currently under construction that are due to be completed sometime in 2023. So where you are in the market will reflect how that hits. This, again, is a report that we look at every single week. This is new inventory based on a weekly basis. So we saw 66,000 new homes come to the market this past week. 20, what does that say? 20%, 25% are already under contract. And that's compared to 100,000 homes coming on the market this time last year. So you heard me say a minute ago, this is the time of the year when inventory starts to pick up. It's not, because last week we were talking about the same number, somewhere around 60,000 or so listings coming to the market. This week we're looking at the same thing, whereas you can look at the pink on the other side of that chart, seeing that this is, it really starts to grow until about middle of summer, and then it starts to back off. We need to see inventory come in order to see, more movement in the market, because what we're seeing at the moment is tough. It's tough. It's tough out there for buyers. So median asking price is staying about where it's been over the last couple of weeks, sitting at 439,900. New listings coming to the market are sitting around 400,000, which is essentially what we've seen. This chart's not really making a big change there, but I like to show it week over week just so you can get an idea what things are looking like. This one, again, is showing median price of homes in contract. The list price of homes in contract sitting around 379,000. It's a little bit lower than where we were this time last year. Percent of properties with price reductions continuing to decline. Now under 30% of homes actually having to reduce their prices. And that's because of buyer demand choosing the very few homes that are actually out there. So Josh, this is a chart that both of you and I were looking at. And this shows, different generations and age demographic of, at the bottom going across there. And then on the side, home ownership rate. And millennials are well under the curve on this. And it has everything to do with affordability and just doing things later in life. Thoughts? Anything you want to add?
Yeah, the report actually goes through and says why, and some of the reasons are interesting. Affordability, obviously, cited there as a reason. Inability to come up with a down payment. That was the reason. No matter where you are around the country, we talked a couple weeks ago extensively about the California Dream for All program, a severely misguided program in the way that it was drawn up, but its intentions were, hey. Millennials, underserved communities, people of color are having a hard time achieving home ownership. And one of the primary issues or bridges to cross there is coming up with the down payment. Jeb, I don't think we've ever really talked about this on the show or the podcast, but it has been proven of all of the things that the government can open up to help people get into homes, the one that has the least negative impact on default rates, it doesn't lead to default, the thing is least predictive of people losing their home, is down payment. We think in terms of skin in the game. You got to have a down payment. Well, when we have 3% and 5% conventional, 3.5% down FHA, 0% down VA, those programs all perform reasonably well. They have insurance. They have insurance built into it. They expect a level of defaults and they insure against the default. When you take that down to a 0 down payment, that can be done safely when you raise requirements of reserves, higher credit scores, lower debt to income ratio. Doesn't necessarily solve, because we talked about affordability as also an issue, but those things can make it safe to get people in with 0 down. I was far less concerned in 2008 timeframe of what a 0 down looks like than I am with, we don't know how much the person makes. We don't know if they have any reserves and they have a horrific credit score. You can look at it as sort of underwriting is a four-legged stool. All of them are important. The property, the collateral, the equity in the home, the down payment is all important, but it's probably the least important of those. So not by any stretch saying that is ideal, but you asked, when I look at that report, what does it tell me? We used to have options that were government loans that, with some restrictions, people could get in without a down payment. And I think the Dream for All kind of showed that there is a big demand for people to get into homes. There were some other weird stuff with that program, but if we can help people cross that hurdle of a down payment, it is important over the long haul. We've bored people probably to death here, Jeb. Homeowners have 44 times greater net worth than renters. It doesn't mean becoming a homeowner magically makes you a wealthier person. It means becoming the person who can successfully own a home, and then letting time and inflation take its impact will have a massive positive impact on your net worth.
No, I mean, good stuff. I mean, that's exactly what we're talking about here. It's time and allowing the market to do its thing, which we talk about all the time. This particular chart has to do with the Fed and predictions of interest rates. So at the moment, I think there's like an 83% chance. Yeah, 83% chance that the Fed hikes another 0.25% in May, which is next month. And then it looks like the market is suggesting that that's where they pause and likely hold until sometime in potentially November, where they see a rate cut. Now, you and I have discussed several times where we don't really see the possibility of a rate cut happening this year unless something major happens with the economy. You're talking about, big problems, like the bank crisis continuing to unfold, where you see any sort of rate cuts. But the opportunity to pause rates, I think, is real. Assuming that we don't see anything crazy happen between now and then. But I think the reality is that inflation numbers will moderate. It'll give the Fed what they're looking for, and that's where we're going to see hopefully rates improve and start to see some upside with regards to those out there looking.
Well, Jeb, if we look back at the beginning of the
Yep.
year, the Fed's mantra was, or people who follow the Fed were saying, higher for longer. So rates are going to go higher than people currently expect, and they're going to stay there longer than people expect. I think we're kind of to the end, or nearing the end. We had Bullard out saying that he sees 75 basis points more of hikes, but he's an outlier there. We probably have a quarter basis point or 25 basis points at the next meeting, and that's likely to be it. But the for longer part, the only thing I would say is, when unemployment is at 3.5%, it's very easy as a Fed member to say we would be comfortable, or it would be desirable to have 4.5% unemployment, because 4.5% has always been considered full employment, record low unemployment. So it's easy to say, oh, we would be okay with that. But the U.S. labor force was 165 million. We're talking about 1.5, 2 million people losing their jobs to push you up another percent. That's real.
It's easy to say now until it actually happens, and then the panic button gets hit. I thought this chart was interesting. This has nothing to do with the market per se, but it does a little bit. It just shows you national Let's start over. National Association of Realtors members as a percentage of U.S. labor force. So look where we were, at the peak. Again, the housing bubble is less important, but where we are now, and I think I forget the number that I saw earlier that 50 something thousand people have not renewed their license since the beginning of the year, letting it drop off just because of the changes in the market, something like that. So a drop there, which is obviously affecting labor numbers, but nevertheless, just shows you as the market changes, we lose real estate agents, which is something we've talked about often. Josh, what did you want to talk about here on this slide?
It really was just showing, this is the National Association of Home Builders data, 45. So that index, within anything above 50 is expansionary, anything below 50 is contracting. So we're under there, but if you look at that chart in November, we were as low as 33. We're up to 45. So anything from 40 to 60 is kind of in the middle of the bell curve, kind of normal stuff. Regional, you see the West at 41. Other parts of the country, you've probably seen the headlines, people saying, hey, East Coast still experiencing a housing boom,
Yep.
West Coast getting crushed. Not at all what we're seeing anecdotally with our clients, the realtors that I work with, talk to, Jeb's network. But the South at 50, South doing the best. It's affordable, it's sunny, and
Sunny. I love the
it's
sun.
all of those things. Midwest, cold,
Don't
and
like the cold.
and less desirable there at 39. So really just kind of wanted to go through those numbers and see it's what we're all seeing. The housing market is not on fire. We talk about housing recession, and we've talked multiple times on the show, Jeb. What does the current housing crash look like? It's a volume crash. It's not a price crash. So volume is low. Volume is low for home builders. The traffic and the number of homes that they're moving isn't where they would like it to be. And we're going to go through a couple of charts here in a minute that it's not likely to change. This, Jeb, I had in here. We got to this a little early in terms of where we are in the range. So we had the yield up here, those candles, the big red and green one at the top middle shows we picked up over 40% in the middle, or 4%. Thankfully not 40%, Jeb. Over
That would be
4%.
a lot.
That would be suboptimal. A little over 4%, and then ran that thing all the way down to under 3.3. It was like 3.26, 3.25 was the intraday low, somewhere around there. But what this range shows us, that bottom line says 3.4 is the bottom of the range. Top, depending on how you draw it, what you're looking at, 3.6, 3.62, 3.64. We closed just under 3.6 today after being up around 3.64 earlier in the day. So the likelihood is this range is just going to keep going sideways. This goes back, for the most part, where we have about 60, 70% of the trading days in that range, going back to the beginning of December.
Yep.
I think it will take a couple of months of much lower data and a couple of bad jobs reports before it really pushes us out of that range. And what do we mean really out of the range? Is it reasonable in the current market for the 10-year treasury to be much below 3.4%? We're going to look at some charts here of what the MBA and Fannie Mae think going forward, but I don't know. A 10-year treasury under 3% tells you that inflation is really under control and generally has been a sign of a very slow economy. So we'll see.
Well, Josh, on that front, I'm going to take this chart off here just for a moment, and let's talk about something, because we look at this spread, and we're sitting somewhere today right around 3.6, I think, right? We end the day just under 3.6, I believe. Actually, we're sitting at 3.5 something. I don't have it up, but nevertheless,
3.59 and change. It's literally just.
We've talked many times about this, and I think it's important to note, because we always have new listeners. There's a spread between the 10-year treasury and interest rates, right? And historically speaking, that spread has been somewhere between 1.5% and 2%, which means if you have hypothetically a 3.6 10-year treasury, that means that your high side of your 30-year fix should be sitting somewhere 2% above that, 5.6, somewhere in that ballpark. On the low side, you could be looking at somewhere around 5%, 5.1%. But what we're seeing right now is it the gap is wider, right? It's sitting at 3%, and it largely has to do with, bond traders out there not wanting to buy mortgage-backed securities, if you will, because of the unknown with the repayment on them, right? Because they think that as interest rates move lower, people are going to refinance and they're going to be worthless. Therefore, they're factoring in a higher margin. But if we just saw that margin come in, and we didn't see the 10-year treasury move at all, right? We just saw some stability in the market. 10-year stayed the same, but we saw that gap come back to a normal, quote unquote, normal gap. You would see rates improve. Am I saying that right?
100%. So here, let's throw it up, because I was going to just talk about it, but this here, if you look, let's ignore everything post-COVID, because we had some weird stuff post-COVID. So this chart goes back to 2013. So at the highest, from 2013 to pre-COVID, was a little bit over 2, maybe there in 2019.
And we're currently looking at that spread between the 10-year and the 30-year, just FYI for those watching.
And just at March 16th, less than a month ago, it was up over 3%. So this had been as low as 1.5. So if we average out these numbers, we took those weekly numbers over that period, it's about 1.7, but from 1.5 to 2%. So call 2% the high end of the range. Today's 3.6 Treasury tells us we should have a 5.6 interest rate. But as of last week's measurement, and this is what we had talked about, I actually showed this chart back in February, Jeb. It was down to 2.54, which is still high, but it's awesome relative to 3. And then what happened? We saw rates kind of go back up a little bit, and lenders again worried about prepayment risk. Not lenders, holders of mortgage-backed securities worried about prepayment risk, not knowing how long those loans were going to be on the book. So again, the difference between, if you buy a 10-year treasury, there's no prepayment risk. The government's going to pay you your interest for 10 years. So you know at any given time the remaining duration of that bond, what current market yields are, and what that is worth. With mortgage-backed securities, you have to also factor in those can pay off at any time. Someone can sell their house, someone can refinance their house. What this is telling us, that big spread, is that lenders, holders of mortgage-backed securities, are very worried that yields will go much lower, and all of the loans that they're buying now are going to have a very short duration. So just a long way of saying, it normalized down to 2.54, and we thought we were going to trend back down to the low 2s, shot back up here, back over 3, and then we're sitting here last week at 3.85. So until you see that well under 2.5, 2 to 2.25 would tell you, hey, we're not back to normal, but we're at the high end of normal. So if we say, what's a normal 10-year treasury for where we're at right now, somewhere between 3 and 3.5. And then if you put a 2% spread on that, tells us mortgage rates should be 5.5%. What we've already seen, Jeb, from the change from having 7.375 interest rates per Mortgage News Daily back in October, November, to we had hit into the high 5s by the first part of the year, and there was a big spike in volume. There's a lot of demand sitting on the sidelines that is willing but not able. As those rates normalize, which, barring something unforeseen, they are going to improve. They're not going back to COVID levels, but they're going to improve from here, and that will bring some additional demand back into the market. And hopefully it'll bring some supply as a few sellers go, hey, I'm cool with that. I will get back in the market.
Now, this is a forecast. I know there's a couple slides up here. I'm not sure which one is which, but you want to talk about forecast? Who's forecasting what?
So remember, opinions are like, you know what, so we take them with a grain of salt, and these two actually diverge a lot from each other. So I want to show this. This is the Mortgage Bankers Association, highlighted right here. According to their measures, in Q2, we are averaging about 6.2% in your 30-year fixed rate. They expect 5.8 in the third quarter, 5.5 in the fourth quarter, down to 5.3, 5.1, 4.9, 4.7. So it's always conspicuous to me when you see quarter after quarter, they just said, it'll be about 0.2% lower. But the highlighted ones to the right, they say they expect the average rate for this year to end up at 5.5 at the end of the year, 4.7 next year, 4.5 in 2025. That's pretty aggressive. I'm pretty solidly in the camp we're going to have lower interest rates. If you tell me we're averaging next year a handle under 5% in the 4s, I would be surprised. This doesn't matter much to you guys, but we always like to see their forecast of what they're projecting for originations. First quarter, we only had 333 billion there. So they're saying, what was that?
Did you pull that? Okay, you did. Okay, it's on the same chart.
Yeah, no, it's on the same chart.
Okay, there we go.
So really, just looking at those numbers quarterly, they're expecting a better year next year. And if we look at the annual years, 2022 was 2.2 trillion. They're expecting 2023 will be 1.8 trillion, and then back to about 2.2 trillion for 2024, and a little bit higher for 2025. Now, remember, when we're thinking in terms of home sales volume, if you expect home prices to go up, loan sizes will go up, and that will result in a little bit of that increasing volume. But they think that the worst is behind us. This is their economic forecast. This is and what they're saying is CPI. Where do they expect it to be? 4.1 in Q3, 3.7 Q4, and continuing to trend down. So if we say 2023, they see 3.7, 2024, 2.6, 2025, 2.4. We know, and we've talked about the Fed would like to see that close to 2%. So even 2.6, 2.4 is above their comfort level. We looked and talked about the 10-year Treasury yield. What are they projecting? They're saying 2023, 3.1, down to 2.6 in 2024, down to 2.5 in 2025. If they're right and that happens, that tells us you have rates in the low fours. They're actually overestimating what the interest rates are, because we will have normal spreads somewhere 1.7. So you're talking like a 4.2 interest rate. So let's just contrast it real quick with Fannie Mae. Fannie Mae says 6.6 next quarter, 6.4 the following quarter, 6.2 the following quarter, 6, not getting down into the fives until the third quarter of 2024, and barely under 6% for 2024. So something pretty similar, better, but not a whole hell of a lot better than where we're at right now. Their numbers on inflation, they are saying we're going to have we ended up 2022 at 6%. 4.1 for core in 2023, 2.9 in 2024. You can look at the core PCE. It's just a different measure. That's the Fed's preferred measure. They expected ending up at 2.6. So both of those numbers are still big improvement from where we're at, where we've been, but above the Fed's preferred measure. So you would expect a slightly elevated interest rate relative to where we've been with lower levels of inflation. And pre-COVID, it's important to remember, we were just above 4%. And we had inflation consistently right in that 2% range. Sometimes couldn't hit 2%, sometimes a little bit above, but those are some pretty good projections on where to go from here in terms of inflation, how it impacts interest rates, and we've seen what lower interest rates than what we have right now do for home sales and home prices. That puts a floor under it.
Good stuff. So with that said, the important questions before we dive into your questions. Do you like option one? This is option one. Far away. You get to see the background. You get to see Josh sitting in his seat. He looks like a little midget on the, I can't say midget, small person on the left side of the screen. Or do you prefer big head, where I'm still taller than Josh, but you get to see how big his head is compared to how wide the screen is?
I'm properly framed to fully take in my beauty. You want everyone to see your t-shirt.
My t-shirt, bro.
That's all we see.
So one is this, two is this. Which do you prefer? Because we want to change it up. If you guys want it changed, we just realized we've been filming one way for a long time, so we're looking at we got ones, we got one and 1 2. That does not help, guys.
Well, Boris said midget mode using the politically incorrect
Dude, you
term.
Cannot say that. We just said
he
that.
He did. Well, like it's a 50-50 break. Maybe just half of the show we do in the tiny ones, and
1.5.
One and a half
says. All right, so we got basically an equal number at this point. This one is better, people say. Okay, so we're gonna stay here. We're gonna switch it. We're gonna see what happens. I don't know
if anyone complains.
Yeah. Anyway, and those for you listening on the podcast, which, as many of you guys know, this gets put on the podcast on Friday, The Educated Home Buyer, on the audio podcast, which comes on Spotify, Apple, all those great places that you listen to podcasts. We take the show, we put it on there. So if you want to listen to it there, you can. It's always on YouTube as well. It does not go on the YouTube, the Educated Home Buyer YouTube channel. That is completely separate. So this week we talked about student loans. Last week, what did we talk about, Josh? I don't remember.
Good question. It was a long time ago.
I don't know. This week, we talked about student loans and qualifying. We recently did an episode on refinancing. These are coming from your questions, guys. We're doing a deep dive into each one of these topics. If you're not watching us on YouTube, go over, subscribe to that channel, watch it. It's different content than you see here than you see on my channel. And check out the podcast if you're not already doing that. If you like the audio portion of it, you can always check it out there. So with
Jeb,
that said,
it was actually that other episode was actually important. FHA versus conventional.
Ooh,
probably half of Jeb and I's conversations here recently, videos he's throwing on his channel, that content we did there, conversations that I'm having. What I can tell you is more and more I am telling people or showing people the numbers, and they are deciding that FHA makes more sense. There's pros and cons to each, but with the new loan level price adjustments, crazy ones across the board, more borrowers, unless you have multiple borrowers with a very high credit score, you're just going to go FHA. So listen to that. We're going to have more content because it's an important topic, and I don't think it's been covered enough. A lot of YouTubers out there made videos on increases to Fannie Mae cost. I don't think people have done a great job of quantifying it so you can see how much it's going to cost you.
And there you go. You have Shay. All right, Shay. Student Loan Podcast was fantastic. So thanks for that. And during this whole time, before we dive into your questions, we have KCW saying, Jeb, it's regard, not regards, except in closing, like best regards. Thank you for the clarification. If you understood where I came from, I'm a hillbilly from rural North Carolina. The fact that I can even say regard or regards is a step up. So thank you from that. I'm a math guy, right? I understand numbers. That's why I was a computer science major. I never did well in English. If you guys listen to my, I'm surprised you guys even listen to me. It's so bad, but I do appreciate it. And I'll try to remember that when I say it next time. I'll probably fail again because I've had people say this all the time, and I continue to use improper grammar.
My favorite Kinstonism, Jeb, is when you say that they're putting their house up for sale.
For sale? Oh, instead of sale?
Sale. Like we're going sailing. I put my house up for sale, not for sell.
It's the same word.
For Kinstone.
Just like
Kinstonians,
my wife,
yes.
when I talk about the back of your foot, that's your heel. When you climb a mountain, that's a hill. It's the same word. It's just spelled differently. It has the same, when I listen to that, sounds the same. So I say it the same. There's many others. Forward. You're moving forward. When I say
forward,
I know, I got like that.
4 words.
But dude, when I voice dictate and I type it, it always spells like a car. I'm like, that's not what I'm saying. I'm saying forward like that. And that's how I have to say it in order for it to come across. So if you guys understand, that's where I'm at. Nevertheless, thanks for letting me go over all that. We're going to get into the important part of the show now, and we're going to answer some questions. So here we go. We're going to talk out Samuel. Samuel is asking the question, can we get a HELOC and use a cash out refinance to pay off the balance of a HELOC? So can you get a HELOC first, and then at some point in the future, you get a cash out refinance and pay off that HELOC? Or is it one and the same, Josh?
You absolutely can do a cash out refinance. I love the question, Samuel, because a lot of people miss that. If you have a second mortgage, HELOC or a fixed second, that was not a purchase money loan, meaning you didn't do a combo purchase, and you later go to pay it off, you are going to be considered a cash out refinance. People back in the day, it used to be if it was a HELOC and it didn't have any draws in the last 12 months, if it was a second and it was more than a year old, it was seasoned. So you could pay those off without it being considered cash out. One of the joys of coming out of the last housing crisis, they changed that. Fannie and Freddie, all loan types really are going to consider that cash out. So it's important to note we have bigger cash out hits now, thanks to the new Fannie Mae loan level price adjustments. So is it going to change your behavior? Is it going to make you decide to not do a HELOC? No, if the HELOC makes sense, it makes sense. Just know it's going to make your refinance when rates drop a little bit more expensive.
Good stuff. Big G has a couple of questions tonight, but the first one is, can you tell me how much my property tax would be on $1 million home in San Diego would be or in Orange County? So essentially the tax rate in California for the most part is 1%, right? What you have on top of that is things like local bonds. If you're buying new construction or construction built in the last 20, 25 years, some communities have something called Mello-Roos that can add additional tax onto that tax. You guys hear that? These guys are over there destroying the bathroom. It's so loud. But nevertheless,
did they already start the demo?
Yeah, the demo is going on right now.
We don't hear it.
Okay, well, I do. So with that said, your tax basis is going to change. It's really hard to say without knowing a property address. Most lenders are going to use 1.25% here locally. I would say, in my experience, that's going to be on the high side for the majority of properties out there. Here in Huntington Beach, I would say 1.1% is a pretty accurate number. And even that might be a little bit high. So, there's easy ways to figure it out. Honestly, just go to the tax assessor's website, type in the property address that you want to be or that you're looking at. It'll bring up the current tax bill. You can actually see someone's tax bill. And that's another word I say, bill. It's all the same. Tax bill. And you can see the current tax rate, the effective tax rate. And from there, you can do the calculation. So Josh likes to use Redfin, I found out. So,
well, it's the fastest, easiest one. And it's generally correct. For us in California, what you can see is the assessed value, and then you can see the total dollar amount of taxes. So let's say someone bought that 3 years ago and they're assessed somewhere near the asking price. Those taxes are going to be pretty accurate. What we have is there's ad valorem taxes, which are based off of the value. So it's a percentage of the value, and those add up to a percentage. And then there's some fixed line items on there. So it's not complicated, but it's a pain in the butt. I actually have a tool from one of the title companies that you plug in an address and the projected sale price, and it does all that hard mathematics for you.
All right, good stuff. ZL says, should I keep an unused fireplace? Is this a feature that even matters if it's a warm climate? So I think this is one of those things. It's to each his own. Today, in fact, we recorded a podcast on value adds that you can do to your property. It's a question that often comes up from people looking to buy property, people that own property. So the episode that's going to come out next Tuesday, Wednesday is going to be on value adds to your property. Has nothing to do with this, but it's one of those things that, when you say remove, there are some people that absolutely want a fireplace in a home, right? And there will be people that don't want to buy your home because it doesn't have a fireplace. On the flip side, there's people like me. I don't care if you have a fireplace or not. I don't use a fireplace, don't really care about a fireplace. In fact, my in-laws, they drywalled over the fireplace. So the fireplace is still there in theory. You just can't see where it was because it's been drywalled over. I think that's an okay approach because chances are you're not going to go through the construction, through the process of removing the chimney on the outside because, for one, exterior modifications just adds a lot to the cost of a remodel. So most people are going to keep the exterior part of the chimney regardless of what they do on the inside. So I think if you're going to do that, just drywall over it. In the house that I live in now, if and when we do the room addition, there's a chimney that essentially we would remove at this point because it actually extends a little bit into the room and we can actually get rid of it and create more space. For us, we would remove it. But again, there might be people that don't want to buy the property because it doesn't have one. So I think it's a matter of opinion. Josh, have there been any?
They're amazing and wouldn't
Who?
buy a
Your
house
mother-in-law?
without it.
Yeah. See,
Yeah.
I mean, what do you think? You have one in your house. When's the last time you laid your fireplace? Ever?
This is the best part, Jeb. You're going to like this. It has never been on, and we had to have it serviced the other day because with our frigid, cold winter here in California, we were getting a draft blowing in through it. So they had to seal it up around the edges and fix the flue. I didn't even know what that means. I still don't. I don't know what it does, but I wrote them a $600 check to
keeps
do
the
all that.
embers from going out the top. So when you burn wood in the fireplace, essentially that chimney cap on the top, keeps the embers.
I think it looks cool. We put Venetian plaster on it and it looks really fancy, but it is never, literally in 23 years of owning that home, been used.
That's awesome. Anya is saying, have there been closings with the Calhaffa Dream Loan? So Josh, it started on the 27th. So I would have a hard time believing that they've closed any of these by now, but I'm assuming there have been some closings. Do you have any updates on numbers?
I do not. I will bet you they have, but it would be like a weird situation where someone was already under contract, had a conventional perfect loan ready to roll, and just said, hey, flip it over, got the underwrite done the first day, send it to Calhaffa for their compliance underwrite, and everything was already in. Just because the timelines of everything, I got to follow up here today, getting your second interview. So in terms of your education with the program, it's not just, hey, I do a 2-hour online course. I do an 8-hour online course. Then I do a second course to understand shared appreciation. Then I do an interview. Obviously, the recorded stuff online is simple and everyone can get through it in their own time. But that 2-hour or 25-minute interview to make sure you understand what you watched for 10 hours is backed up. So I would bet I have not heard of any.
All right, good stuff. Let's see. Big G, another question says Warren Buffett said inflation is here to stay because people want free stuff and the Dems are more than happy to give it to them. So spending is going to continue. Did Warren Buffett really say that the Dems are more than happy to give it to him?
He's very politically correct. I doubt he would have said
I don't
that.
think he said that, but he might. He probably said that.
I think Big G
But
sort of
that's okay. That's
put his
okay.
commentary in.
Can you guys give your opinions? I do believe, I don't know that inflation is here to stay because people want free stuff, but I do believe people want free stuff. And we have created this idea now that the government is willing to do that and willing to back people and businesses and individuals when things go wrong. And that's a precedent that we've talked about before. I don't think you want to set. It's not a good thing. I don't know what that means long term for inflation. The U.S. is constantly funding everybody else's problems globally, and now we're doing it here locally, nationwide as well. So does it lead to additional problems later on? Yeah. We're sitting at 33 trillion or so in government debt, and that's going to continue to be a problem. Where that leads, hard to say.
I saw one yesterday, Jeb. The mayor of Los Angeles, I think, wants $150 million to cure homelessness. I can tell you, if we gave her $150 billion, she wouldn't cure homelessness. The ideas out there are all, let's build a bunch of tiny houses and give them homes. People aren't homeless because they don't have a tiny house. They're homeless because they have issues and problems that need to be worked on. It's crazy. You see stuff that will say, well, this person just had bad luck and they got this assistance and this assistance. They got a good job and they got an apartment. Yeah, those people are out there, but they are the exception versus the rule of people with much bigger mental health and drug issues. So all that stuff. Any long way of saying where I was going with it is we keep thinking, here's a problem. It's not good to have people suffering with this problem. Let's give the government money to fix it. So bigger picture, what is showing, deficits were always thought to be inflationary. Deficits themselves have been shown to not be inflationary. They're actually deflationary as it pulls money out of circulation from productive purposes and goes towards debt service. But what is inflationary is what we did during COVID. We spent trillions in a very short period of time and basically created the money, increased the money supply at a spectacularly rapid rate. So we had more money chasing an even smaller amount of goods and services due to shutdowns. And now we are still sitting here working our way through the effects of inflation. So I don't know. I don't believe inflation is here to stay. I believe the longer term trend towards lower inflation, lower growth. There's actually, Jeb, it's probably worth having the conversation. 2% inflation was made up by the Fed about 25, 30 years ago. There's nothing magical about it. We probably would prefer to have a little bit higher inflation and a little bit higher growth. So when we say, hey, inflation is unlikely to be a problem going forward, it also tells us we're unlikely to have the growth that has led to prosperity over the last 100 years. So there's two sides to it.
Absolutely. I mean, that's why the government wants some inflation, right? They don't want inflation at 0. They want inflation at 2% so that you get some GDP, you get some growth in the economy. So I agree with you. I don't think inflation is here to stay, but I do think we've got problems out there that aren't easily solved, and government spending and government bailouts don't help that. That's really the my thoughts. So
we have a winner for comment of the day already.
Ooh, already?
Sam Hernandez comes in and says, if they gave me $150, I'd slap the mayor. And I say, I have $150. I want to see it happen.
I think if you pay, here's the deal though. I think if you paid Samuel $150 to slap the mayor, you are then somehow involved when he goes to jail for slapping the mayor. Yeah. I think that because you bribed him, in theory,
he asked for it. I didn't offer it. He asked for it.
I know. But I think somehow you go to jail. So this I want to see. In fact, I'm willing.
You want me and Sam to get in trouble. Okay.
I'm willing to give Josh the $150 to give to you just so I could see the outcome.
This is now a conspiracy. You're going to go to jail for conspiracy now.
I like the way I like the direction this thing's going, and therefore, If you guys contribute $150 right now in money
$150 of super chats,
of
and we're
super
all going
chats,
to
I
jail.
will turn that money to Josh, who can then turn that money over to Samuel, who will then slap the mayor of Los Angeles, and we can all tie it back to the show. I think that's good
I think it's
TV,
a good
guys.
idea.
I haven't been doing this long, but I think that's good TV.
Yeah.
All right. Let's go. We're going to go a different direction here. What's with listings? They make tiny single digit price adjustments. What's the point? So here's the thing. As an agent, you're constantly, when homes are sitting, you're constantly trying to, or you should be trying to have conversations with your client of why the home's not selling. Oftentimes it can be prices a little bit high. So you want to slowly get it to where you think it should be, if you will. Some sellers aren't willing to adjust in 3 to 4% ranges, or 5 or 1%, or whatever the number is, right? They're only willing to do small single percentage adjustments. And as an agent, I'll take what I can get, right? I want to show the market that my seller is reasonable by adjusting their price, that they're not stuck on that same price, never willing to adjust it. They're slowly, gradually getting into it, because what will happen over time is most sellers will come to the grips that they're priced too high, and they'll slowly get in there. And then agents, every time, guess what? Every time we make an adjustment to a property, guess what happens on Redfin, on Zillow, on whatever? It alerts you, if you've been following that property, that a price adjustment's been made, puts it back at the top of your list, creates more exposure. Exposure drives demand, demand drives price. In theory, we're getting more eyeballs back on that property, which in turn will help us move it quicker. So, it's I don't know that it's always the wrong answer. It's not always the right answer either, but it is getting, the price moving closer to where it should be. So, my thoughts on that. Josh, this is a question for you from the Art of MD. Says, my lender told me I can't buy down my rate because there's a limit to the fees he could charge. Is this true? FYI, I am using down payment assistance.
So the down payment assistance program itself can have limits above and beyond what the federal laws are related to this. But yes, there are limits to what can be charged in a transaction. There are discount points. Discount points to buy down the rate either can be considered bona fide, meaning it's not a profit center in there, or not. So a lender can say, hey, we're charging you 1 point for the rate and then 2 discount points. Well, if it's not reflected by the rate, and they actually have to document in the file, here is the undiscounted rate, here is the discounted rate and what's being paid for it, but it's kind of a gray area. So there is a practical limit on how much you can buy a rate down. And the craziest thing is, if I pull up a rate sheet today, I can offer you guys a 4% 30-year fixed. It's like 14 points, and it would never pass a compliance test, but it's available if you wanted to pay 14% of your loan amount to buy the rate down to 4%. So I don't think you're being misled, but on top of that, the second part of your question, the DPA can have their own guidelines of what can or can't be done with buying a rate down.
All right. Good answer to a good question. Josh Dina, one of our regular viewers, says, why would Fannie and Freddie change all the loan level price adjustments? Or why would they change all the loan adjustments now of all times in history? So why do they need to make more money, Josh?
That's a really good question. Their whole business model is built around these loan level price adjustments. The craziest thing is, if you put less than 20% down, you're going to pay for mortgage insurance, right? Your mortgage insurance rate, Jeb, you and I have gone through the numbers multiple times, is a function of how much you're putting down. The less you put down, the higher your mortgage insurance rate is. The better your credit score is, the lower your mortgage insurance rate is. The lower your debt to income ratio. So they measure the risk and they insure. So the lender is insured against loss. So why would we adjust the interest rate with loan level price adjustments? Why would we charge more for something that's
Gotta make more
already
money.
insured?
I need more money.
It goes back to money. So currently, the people we have in charge of the FHFA, which regulates Fannie and Freddie, for lack of a better word, it's wokeism. They're sitting here saying, we want to help certain people, and to do that, we're going to tax other people. So we had an increase. We've always had, since high balance loans were created after 2008, there's always been a 1 point hit for a cash out high balance loan. And you're like, okay, they don't really want to do high balance loans, so they really don't want to do cash out, so they'll have that hit. Well, they added one for purchases. So they just said, we don't want to do high balance loans, as if it's your fault that you live in Los Angeles County and it's hard to get a home with a standard balance loan. But there's always been a logic to it, but now it's simply saying we're going to shift these things around. If you look at the changes, people who are putting the least down and have the lowest credit scores had their loan level price adjustments decreased massively. Nearly everyone had small to large increases to their loan level price adjustments. And when I say woke normally says that we're trying to create equality by forcing things through. But the crazy thing is, credit score, although credit scores vary racially, like if we show a chart, Asians have the highest credit score, Caucasians have the next highest credit scores, Hispanics the next highest credit scores, and Blacks the lowest credit scores. So we could say we're going to decrease the loan level price adjustments for those with the lowest credit scores because that will disproportionately help Black borrowers. But the reality is, by doing that, you increase the terms for people with good credit. So my Black borrowers that have an 800 credit score are paying more to subsidize the Black borrower who doesn't. So it's not the Black skin that makes the person have the bad credit score, although as a group, when we look at averages, those credit scores are lower. So nearly every borrower that I talk to, no matter what color they are, when you explain and you go through what sort of the thought process here, it's for a good objective, a good outcome. It's just a horrible way of doing it, because what we're doing is we're incentivizing people with bad credit and a low down payment to get into a home, when we should be saying, how do we build systems to help these people better manage their finances, improve their credit scores, save some money, and have a slightly higher down payment? So rant over.
Rant officially over. All right, so let's move along from that. Where do we go? Where do we go from that? A couple questions here. Samuel asking about 203K loans in LA County. So you mentioned LA County a minute ago. Why? Like, I was just in LA a couple weeks ago. Man, I hate LA. I really do. Like, I'm sure there are great parts of LA like there are everywhere else, but downtown LA, oh my, like, I was near Hollywood and all of that. It's just the traffic. I cannot imagine. I told my wife, I was like, I don't know what amount you would have to pay me to do this every day, but it is way above any number that I'm making now to be able to sit in this traffic and do this. I mean, it took like 30 minutes to go 4 miles, but nevertheless, that's my rant. But Samuel's asking the question of how common are FHA 203K loans in LA County? So here's the thing. Historically speaking, I don't know. I think that there's probably a lot of people that have done them over time. In the market, in the environment that we're in now, I think probably on the lower end of the percentage of loans taking place, because, again, you're dealing with low inventory out there. Any home that needs a lot of work is likely some sort of investor buying it. If it needs a FHA 203K loan on it, chances are it's getting offers from, investors, cash offers, that sort of thing. So I think you're probably competing against that, versus just, if it doesn't need that, you're competing against the normal buyer, putting more money down and that sort of thing. And traditionally speaking, at least in my experience, and Josh can speak to this, is that FHA 203K loans aren't a slam dunk loan you get done in 30 days or less. It's 45 days, it's 60 days in some cases, just because of what goes into that process. So I don't know if, Josh, if there's a way to know these numbers, exactly, or even close to what they are, but I would say that they're, it's not a lot of people.
The actual number for fiscal year 2022 nationwide was 0.6% of FHA loans were 203Ks. And FHA loans are a small minority of the total loans done. So it is a very, very small number. And I would also say they are less common in high-priced areas. More common in the area where you can buy $240,000 home that should be a $325,000 home, do $60,000 or $70,000 worth of upgrades and get in. And it's just a function of the way they work, in terms of how you have to sort of prepay some of the work and then get reimbursed on a draw schedule. It just doesn't work very well in high cost areas. That being said, I have a client right now in LA County. They actually work in the trades, so they have the ability to do a lot of the work themselves under the guise or under the direction of a contractor, because you can't be your own contractor on a 203K. And they have an opportunity to buy very distressed property at a very reasonable price that they feel like they can, for $250,000 make pretty cool.
And Sam came back and said, talking Downey, Whittier, Norwalk. So again, much better than being downtown LA. But I still think in those markets, you're competing against the buyers. They got pushed out of other areas of, say, of Long Beach, like Lakewood and some of those areas now where the prices are higher. But Norwalk is pretty close to Lakewood. And so now you've got people that are pushed out of Lakewood now going to areas like Norwalk. And so what I'm getting at here is those markets are competitive. So getting in with a 203K is going to be a little bit more difficult, not impossible, just difficult. All right. Let's see. Josh.
You pissed Wesley off. Says, whoa. I'm from
Wesley.
LA County and there are very nice parts.
Dude, there are nice parts. I drove through Beverly Hills. It was beautiful. Beautiful.
not worth the trouble.
Hollywood is not where I would want to live. There's great houses up there. There's fantastic houses up there. The traffic sucks. It sucks. And anybody that's outside of here, when I say sucks, it sucks. I was on the 101 forever. Like, why would anybody do that? There are better parts of the country. I don't know what you have to make to be able to deal with that sort of thing. Like, you have to love being just stressed to the max. I mean, you'd have to like meditate for just days on end to get over the craziness. And Wesley says he got pushed out of Lakewood and now he's in Vegas. So, but you just said you were in LA, bro.
Well,
he's from LA.
He's from LA. Hold on now. We're going to make it the Sam show tonight. So Samuel has another really good question and a really good opportunity to pitch the podcast, because again, 2 weeks ago we did FHA versus conventional. We went into detail on this stuff. So go check out that episode. It really is a very good episode, very timely in regards to everything that's going on with the loan level price adjustments. But if you put 20% down, do you still have to pay PMI? Absolutely. The only difference is if you put 10 or more percent down, it will fall off after 11 years. You're not going to have that loan in 11 years. You either sell or refinance. So it's not really a benefit. It's also not really a worry that your FHA loan to get into the home is going to have it for the life of the loan, because that's not going to be very long relative to you. The second piece there, does FHA have better rates than conventional loans? They absolutely do. And normally I would say 0.5%, whatever you're looking at for a conventional loan, it's about 0.5%. In the current market, I ran it for 3 borrowers this week. They were all looking at almost or actually at a full 1% better on an FHA. That's why I'm saying with these loan level price adjustments, unless you have an 800 credit score, it's pushing more and more low down borrowers. 5% down and less are being pushed heavily towards FHA. So Jeb, we ran the numbers and you were kind of stunned when we looked at sub 680 credit score. There's no world in which you're doing a conventional loan. You're just not.
That's crazy to me. Absolutely crazy.
And people think, another thing, we did an episode.
680 is not an awful credit score. 679 is not an awful credit score by any means.
It's not. What I was going to say, Jeb, referencing back the 2 episodes we did on credit and managing your credit, improving your credit, we looked up what is the median credit score. So what puts you exactly middle of the road?
It was like 720, right?
Yeah, we were shocked to find it. I believe it was 726. Yeah. I would have thought 700, high 600s. It's actually 726. So from the FHFA's perspective, if you have a sub 680, you are an incredible risk to them. And not only do they need you to pay a high mortgage insurance rate to insure them against that, you need to pay a premium. So from that perspective, if you don't have a 680 and you're not putting 10% or more down, we're most likely going to be looking at FHA financing. And don't take my word for it or anyone else's. Have them show you the terms side by side.
Good stuff. All right. So just over an hour into the show, I'd like to ask a favor. We're sitting at 45 likes at the moment. If you find any value in the show at all, we've answered your question. You like Josh's pink lights in the background there, hit the thumbs up. It helps the YouTube algorithm push it out to more people, which ultimately helps us accomplish our goal of educating home buyers and guiding them through that process. So that helps. And if you're not subscribed to the channel, do me a favor and do that. And if you're listening to the podcast and you haven't subscribed on the YouTube channel, that would be awesome as well. Again, it's another deep dive into, home buyer education, really the reason that we're here, the reason that we spend 1.5, 2 hours every single Wednesday, almost every single Wednesday, over 100 hours a year talking about education when we could be doing other things. But we're here helping serve you guys and hopefully bringing some value with that. So thank you.
Jeb.
Yep.
Christina's here to say hello.
Hi. What's
And
up, bros?
Her picture clearly cosigns on my pink lights.
There she goes. Pink lights. Hi, Christina. Hi, Christina. Welcome, Christina. Christina is a more successful YouTuber than myself.
Just about everyone in the housing space.
Yeah, I mean, she's considerably more successful. So if you'd like to know what's going on in the world of real estate and land and tiny homes and affordable housing, Christina's a really good place to start. But thanks for stopping by, Miss Christina. You're always welcome. Let's see. All right. There you go. Look, Shay, we said,
Shay. Yep.
Found Christina through the podcast collaboration. We did a collaboration on the podcast. I don't know. I don't remember. I don't think so.
Not on the podcast. We had her on last fall, right? When
on the show at one point. Yeah.
But we had a stretch of guests. But Shay is a professional YouTube watcher because you cannot release a podcast or a video that he doesn't know and can quote back to you.
There you go. That's awesome. All right, let's do this. Let's continue to answer some questions here. ZL has a comment more than a question, but it's something I want to touch on. It says California home values won't crash because the state will keep injecting money into the Dream for All debacle. I think that that is not
that
true.
Ship has sailed.
Yeah, I don't think the state will go that route again. For one, we didn't have the money in the budget initially to even do that $300 million program, much less inject additional money into it. Now, is there a chance at some point they do another program? Sure. It won't be this type. It won't be a 20% down would be my guess. It'll have different stipulations because this time, they ran out of money in 2 weeks, $300 million in 2 weeks. It was gone. So it'll vary next time. It'll be more restrictive. If it ever comes again. But again, I can't imagine seeing anything like that anytime. I think the fiscal budget renews in July, maybe, Josh? June, July? Something like that.
June, July.
It'll be interesting, but I don't think you'll see it. Anyhow.
The problem is, it's a lottery. 2,400 people won the lottery and everyone else got nothing. And it made too big of a difference to those borrowers. It changed that borrower too much. It increased their qualifications $150,000, a massive amount. So you just can't hand someone a 20% down payment, even if they're going to repay it. The economics of it, I don't think are bad. I think in the long run, the state will come out okay. In the short run, we're basically incentivizing buying homes when we're saying homes are too expensive. That's crazy, right? These things are too expensive. Here's some monopoly money to go buy them with.
Yeah. And we don't really have the inventory out there to begin with. So go take the rest of it off the market because that's going to help lower house prices. All right. Wow. We're getting a lot off our chest tonight, Josh.
Jeb, Christina says she was invited on the live stream once. So I think
one time, that's it.
We should invite her back because she likes it here.
I'll send you an invite right now. Comments. I will send you an invite
next Wednesday. It happens.
You tell me you want an invite. I'll send one right now. And if not, you probably don't even have your hair done. You're probably sitting with rollers in your hair at the moment. Don't have the fancy background. I know what's going on. I know what's happening here. Latoya says, what is my opinion regarding home prices in Florida? So I don't follow Florida enough to be able to give you my opinion on it. I do know, reading people's comments, viewers' comments, often Florida real estate is continuing to move. It's continuing to be a hot market. And a reason for that is even something I read today or yesterday says how hot the Miami housing market is. Yet every other day I see a video from a YouTuber that's down in that space telling me that the market's crashing. Yet that market continues to outperform. Nevertheless, I know it's a hot market for people because, parts of it have more affordable housing relative to other parts of the country. It has relatively good weather compared to other parts of the country. And, it's a red state, and a lot of people are leaving, blue states for red states for various reasons. So it has a lot, if you're into all of those things, going for it, and therefore people still want to be there. And therefore I think it's a strong market. Now, are there places in Florida that are overpriced and maybe inventory's building? Sure. I think there are probably parts of it, but I think for the greater majority, it's still a relatively competitive market. Josh, anything you got on that? Anything on Florida you
No,
want to get off your chest?
no, other than it's a lot like most parts of the country that appreciated a lot. You start kind of hitting an affordability wall. So I don't think there's really a recipe from the things I'm seeing from on the other side of the country that are telling me we're going to see a big crash. We didn't have the massive overbuilding like we had in the early 2000s, but they're going to hit headwinds just like everywhere else in terms of affordability. If and when rates recede, if those numbers are correct, we end up in the next 24 months at 4.5%, home prices will move higher because there will be more demand able to step in and buy those homes.
Good stuff. Daniel coming in with a $20 super chat that's going towards my gift to Josh, that's going towards his gift to Sam, who's going to smack the mayor of Los Angeles for $150. So we're $25 of the way of the 150 now, guys. We're getting close. We still got some time left in the show, 50 minutes. Thanks for delivering high quality content in a genuine and consumable way. Side note, Josh is the most succinct person that's ever existed. I don't even know what that
He just wanted to hear you say succinct, I believe.
I don't even know what that means. Explain to me what succinct means.
Jeb, it is brief and clearly expressed. Is the
did you
I wanted the exact definition.
So is he
insulting me? Is he insulting me?
Yes, there we go. The most clear person that's ever. I would long-winded person.
Jeb's mad because he's the least patient person in the history of the world. So if you say
that's why I can't live in LA.
If you say sentences longer than 3 words, he gets mad and just tunes you
get
out.
to the point. You get to the point. All right, Christine, I'm sending this link. So let's see what we got. Josh, we're going to have a guest here momentarily.
But, she's going to join right now with the rollers in her hair?
I think so. I got to send it to her. So find a question and answer it so I can send this over to Miss Christina.
I like this one here. So Mike Bodway says, if you were the federal government, what policy would you create to encourage first-time home purchases? First-time home buyer tax credits, 40-year mortgages. Let's step back and say incentivizing anything in a limited supply market is dangerous. California just proved that on a major level. I think we should incentivize housing, but you have to do it in a way that preserves the integrity of homeownership. Again, homeownership is good. It's good for the community, good for areas, good for families, all of that. But it doesn't magically make you a better person, a better neighbor, a better parent. It's the process of going through that. Now, is it harder now than it was 20 years ago, and which was harder than 40 years ago? Absolutely. So I think we should incentivize it over time. The supply-demand imbalance is the problem right now. I like reducing down payments, even potentially a zero down program solely for first-time home buyers, and or tax credits that can sort of ease the sting of you coming up with that down payment. I'm not against you having to save it, but then getting some of it back in a tax credit. But even those things, anytime the government steps in and puts their finger on the scale in the favor of homeownership, it works. It does work. So our biggest issue right now is affordability, which is mainly exacerbated by lack of supply. Rates are going to take care of themselves, but prices due to lack of supply are not. So I don't know if I had an answer. Jeb, do you have an answer on that one?
I don't. I actually got lost once I started looking at the super chats, and Sam started contributing to his own fund,
his own delinquency.
Yeah, so we're going to bring Christina in. Christina's actually here already. Let's see.
I had to get the rollers out of my hair. I can't even believe you said that.
Your hair looks so nice now.
I was like, oh my God, is this 1957? Like, oh, I got to get my hair blow dried for the night. What are you talking about?
Come on. You have somebody probably come do your hair. at the house. There we go. I know what's going on down there.
Yeah, I wish. One
Eddie's
day.
doing your hair right before you go on the show.
Yep, that's him.
Makeup,
Eddie.
hair and makeup. So before you came on, we actually have a question here for you. But before you came on, Samuel asked said if somebody gave him $150, he would slap the mayor of Los Angeles.
Oh.
And Josh said he would basically give him the $150 to see it happen. And I said, Josh, you can't really do that because I think you could go to jail. So in turn, what I'll do is I'll give Josh the money, who then in turn gives it to Sam. Sam slaps the mayor. We're all good. But then,
well, here's the problem with all of this. This is all live recorded. Once it's on the internet,
I said,
you did the whole chain of command on how the money's getting passed out.
I said, I don't think anybody should do that. But I did say at the same time, if
you would
money
be in
was
favor
made tonight,
of you doing it, but don't do it. And I believe the good news is, Christina, since you are here with us, you are now part of this criminal conspiracy, and we are all going to jail.
Come to Louisiana. You're done. You're
I think Fox News just got in trouble for this kind of thing. So I think they just got sued for like $800 million and I lost. So I think you should do this. I think this is a really bad idea.
I think that's really fair to say. So Sam, if you'd like your $20 back, I will gladly refund it because I think we're going the wrong direction with the channel. We're more about home buyer education than we are slapping the mayor. So, but Christina, we have a question from Wesley. I'm not sure if Wesley shows up on the show, but he says, has the algorithm not been telling me about Sunday Lives, or have you not been doing them? So I think you've been doing Sunday Lives still, right?
Right. Yeah. So I hadn't been posting on Tuesdays. I took a 6 weeks hiatus from actually edited videos, but I've been doing a live stream every single Sunday. I did take Easter off to spend time with my family.
How dare you?
Yeah, I know. It's 3:30 every Sunday Central Time. 3:30 every Sunday Central Time. And
awesome.
and I've been actually doing the solo thing, Jeb. I've been like for the last several
That's
weeks. Tough. It actually worked out a lot better because I found out that I love to talk.
That's fair.
Yeah. Sometimes, and I think I've had some guests that just don't, they're not really good at live streaming. You know what I'm saying? Like, that's
fair. Yeah. And we sent out an invite. You showed up immediately, came on, charisma, got your hair done quickly, makeup on. I
could
know what's
you off right now. I would.
What time is it? It's 9 o'clock there?
8:16.
8:06. That's 2 hours. All right. So guys, we have a guest. So if you have additional questions for Christina, throw them in there. You don't have to stay. I thought it would be fun to throw it out there and you come on. So don't feel obligated to be here for any reason. But you're welcome to stay if you'd like to be. All right. So with that said, if you're not subscribed to Christina, go out and check out her channel there. I don't like the flow of the three people on the screen though. You know?
They have some different, they have some new setups. Ooh, that looks.
Now we get half of Christina's face in a much closer zoom.
Back up.
You don't like that?
Yeah, you don't like that look? Is that too much?
You got this. That one's too much. I don't like that. I think this is the best option. This is what we've got for now. Because yeah. So anyhow, this is where we are, and this is what we're doing, guys. So let's talk state politics. Does anyone think state politics? So here's the question. So this is a real question. Does anyone think state politics influence people moving or buying in particular states? And I will say 100%. The answer is yes, absolutely. Take California, for example. Super majority Democratic, doesn't matter which side you believe. Super majorities, in my opinion, are not a good thing. Doesn't matter which side of the fence you're on. Therefore, in California, it's resulted in a lot of policies coming up time and time again. They don't get approved. They just come back on the ballot. They get voted on again, and eventually they get approved. But look at California, high state taxes, high income taxes, just across the board. People don't want that. Therefore, they move. They want to get out of state. They want to get to places look at the migration patterns out of California. It's to Florida. It's to Arizona. It's to Texas. It's to Tennessee. It's to Las Vegas or Nevada. Las Vegas isn't a state yet. So people want, freedom to some extent with regards to some of these things. And therefore it influences their decision.
In that same breath, a lot of people are leaving Florida because they feel like they're losing their freedom. So,
exactly.
Every state has its ups and downs. California has its ups and downs. every state that has its pluses and minuses, but I do see a lot more migration because of people's political leanings. I
No,
will say
absolutely.
that.
Josh,
Mhm.
what are your thoughts on the political landscape?
You would be naive to think it's not the case. I was in Texas
Mhm.
with one of my buddies a couple of years ago, and during COVID, his son was going to Columbia University in New York, and he's like, you couldn't have two more crazy, separate, distinctly different places. Like when he got to school, everyone had masks on, everyone stayed away from each other. You didn't go out, and then he would go back home to Texas, and everything was just status quo. So people are definitely migrating and moving to get to places where they are more comfortable and what more fits with their lifestyle. Not to mention the entire South, you have better weather and generally lower costs of living. When you combine that with generally different politics, it's a recipe for mass migration.
I
Got
will
it.
give
Are you
a
getting some
little thing.
feedback in the mic? I don't know if maybe Christina's on speakers.
I'll take them down.
No,
Loud.
it's all good. It's just the what is it called? The refurb.
The reverb.
Yeah, coming back in. So
What I will say, Jeb, is the important part is if you move for politics, adopt the politics of where you're going. Don't come from some place where you're fleeing the politics and bring those politics with you.
Well, that's what's
in
happened.
terms of your voting. 100%.
Yeah, and this show is not a political show by any means, but if you look at, a lot of people think I moved to Austin right? Texas is a red state. I moved to Austin, it's going to be red. Or I moved to Boise, it's going to be red. Or Las Vegas, it's a red state, it's going to be red. The reality is a lot of these really densely populated metro areas aren't what you think they are, because a lot of people have migrated for one reason or another, brought the politics with them, and now it's changed the dynamic of those major little metro areas. So again,
Austin was always a little left leaning, and let's just be honest.
okay, yeah, I don't know enough about it to know.
Austin is incredibly blue.
Yeah, it was like their whole thing was keep Austin weird, because it's always been kind of like a little off the cuff of everything else. But I'll tell you another reason why people migrate, because of the changing weather patterns. Some people just want to get away from like the hurricane central, and they're more concerned about climate change. So there are people that are leaving certain areas because they're afraid of what's going to happen with climate change. That is a thing.
No, I mean, we just had our coldest winter ever, Christina. I think it was in the 40s for a period of time, a couple of days.
My house is actually 1 foot below sea level and in a tsunami warning area. And I don't know that Jeb's is a lot better. Jeb, I think you might be 1 or 2 feet above sea level.
Oh no, dude, I'm quite a bit above.
Are you?
I think.
I'm
pretty sure.
We are. So
I think I'm probably like the highest point in Huntington Beach, or pretty close to it.
I am literally behind the wetlands and in the tsunami zone. So you hear about the stuff of climate change, normally not a climate change denier, but hearing that it's going to cause massive problems for housing and people are going to be underwater. I go, if that is in any way true, I am the most susceptible person in the world to that.
I live in South Louisiana. I don't want to hear about you're susceptible to poop.
You're like 6 feet below sea level.
Yeah. And we've had record floods, like 500-year floods, 1,000-year floods, in more succession than we've ever had in history. So it's to deny it completely is silly. Even like the old grandpas here, they're like, I don't know. I think there's something to this climate change thing. I've seen more water under our house than I ever have. There's areas that have never flooded before that have been underwater.
They're now flooding.
I think there's a little bit to that, but it's a depletion of our wetlands here, because they let all those oil companies come in and deplete the wetlands, and then all the water started coming up further up through South Louisiana. It's
interesting that you say that. I was scrolling Instagram this morning, came across this video of Venice. And these people were walking around Venice, the country, the city, Venice in Italy. And I mean, they're in like 3 feet of water walking around at the time because of high tides and other things. And the premise of the video was like, come to Venice before it's completely gone. And rising tides and the fact that it was built on basically like sinking marshland or whatever it is out there. It's just, I don't know.
Have you ever been? Have you ever
Irony?
been
I
to
have.
this?
I have. Yeah. And it
Yeah.
was,
So half,
I was not
good
walking
portions
underwater.
of the building are underwater.
Yeah. So,
Jeb, we actually have a very good question for
all right,
Christina.
let's hear.
Shay is back and says, how are things going for you with your search on tiny homes for veterans? So tell me a little bit about what you're doing with veterans. Every Tuesday, except we're at a four-week hiatus, over on the Vetted VA channel, I host a Vetted VA Live where we go through in detail VA guidelines, because as you well know, on the internet, lots of big marketing call centers chase after veterans and then give them awful loans and charge them too much for it. But tell us a little bit about what you're doing with veterans.
Okay, so back in 2017, a group of real estate agents and other people had gotten together, and we were forming a group that was getting funding for tiny homes for veterans. That ended up turning into tiny homes for the homeless in the area, because we had an influx of homeless people that were dropped off into Baton Rouge. Like one day overnight, busloads of Amtrak buses were dropping off, or Greyhound buses were dropping off homeless people to Baton Rouge and New Orleans. So we had come up with this whole plan. The thing I've learned about anything that is nonprofit, political people love to put their name on it, but they want to do nothing to help it actually move forward. So here we are, 2023, a lot of people flapping their lips, lots and lots of fundraising, but not a thing has been done. And I had to step away from that, I think mid 2022. I stepped away. I couldn't do it anymore. I had given them so much resources, so many things, so many people that wanted to help. And then we just didn't move on anything. We got a piece of land that was donated to us, to that group. Found out we couldn't build on it. So then I was like, well, what if we put it on stilts, which most of the homes that are still standing today, that are old plantations, are on stilts, because guess what? We flood. Well, that wasn't an option. I don't know. I feel like a lot of times whenever these things are set up, there's good intentions, but very little follow through. It's a very frustrating process, extremely frustrating.
Yeah.
But we did a lot of benefit. We did tons of benefits. Lots of people got their pictures in the paper, lots of handshaking, a lot of politicians doing their, doing their thing, saying that they're supporting the veterans, but it's all horse poop.
There you go.
Yeah,
Josh,
and if you really want to get me mad and no filter,
let's not
Yeah.
get you mad. This is a positive show. We're very positive people here.
It makes me cry, honestly. It was
that's
so
not good.
frustrating.
So rollers in your hair, you're crying. This is not good, Christina.
Like I was literally on fire when you said that. I'm like, of all things to say,
I will show up without rollers and show him.
I'm going to prove to him right now that I don't have rollers in my hair. Send me that link, boy.
Rollers.
Look at that. See, I told you guys. And she said, what is this, the 1980s? Like, who has rollers?
She said 1950s. Yeah.
1950s.
See, he doesn't even listen. He doesn't even listen to women. He wasn't even paying attention.
That's what my wife
says.
says. You guys, I feel like this is a show that is turning against me, and I am not okay with it. No, I'm just kidding. Let's answer some questions. People are here for that, and I would like to assist if we can.
Jeb, let's go through this one. This is actually an easy one. We're talking about affordable housing, getting people in, down payment assistance programs. ZL says, isn't it silly that a first-time home buyer isn't a true first-time buyer? Why is it someone who's owned a home previously eligible for those benefits? Only real first-time home buyers should get perks. And I think what he's hinting at is for most loan programs to be eligible as a first-time buyer, you have to have not owned a home and taken a mortgage interest deduction in the last 3 years. And the only reason why I can think that is most people don't have 10 or 20 or 30 years of their tax returns to show that they've never owned a home before. It's very difficult to prove a negative. So how can someone show me they haven't owned a home before other than the last 3 years tax returns? If there was another way, I'm all ears, but I definitely understand the thought process is to help someone who doesn't own a home, has never been in, to get into the market. The crazy thing, our California Dream for All, I don't know if that news got all the way back to Louisiana, Christina, but we had a crazy program here. And the most insane thing about the program is you could own a rental property. Their requirement was you don't live in a home and take the mortgage interest deduction. Why are we incentivizing buying real estate to someone that already owns real estate? We have finite government resources. If we're going to allocate them to increase home ownership, we probably should make sure that those that most need it are getting it. So any thoughts on that, you guys?
I think I think there should be I agree with them. I think there should be a first time home buyer, a true one. Like your credit report would show if you've ever owned a house before, right?
It would show if you ever had a mortgage.
If you ever had a mortgage, it would show that on your credit report. If they had a true first time home buyer incentive, I would support that big time.
But even that, Christina, 7 years after it's paid off, it will fall off your credit report. So
how many people pay off their house in 7 years?
No, I'm saying after 7 years, there would be someone out there that could show it. But yeah, you're right. I mean, there's ways to restrict it more to show. I mean, realistically, we get on a fraud guard or a background check, our underwriters will come up and say, hey, prove to me that Jeb Smith doesn't own this house in Minnesota. And you're like, well, there's lots of Jeb Smiths. Like, why are you asking me that? And we have proving a negative. It is oftentimes we got to go through and say, well, this is this Jeb Smith, or this is why this is not ours. So they could track down the data. There's more ways of showing that people have owned a home before. But I would say the programs that are going to do the most and give the most assistance should truly be limited to someone who's never had a bite at the apple before.
But everything is inclusive now. You can't leave people out. You can't do true first-time home buyer programs because that means that people have owned a house before can't take the same benefit. Honestly, that's what we've created to some extent, right? And
what if you got
I don't agree with it. I'm not saying I agree with that. I'm just saying that's the precedent that's been set.
Right.
So we don't really have an answer for you, but there really aren't any out there. I mean, the definition is essentially somebody that has not had a mortgage, owned a home in the last 3 years. And then you start getting, people like, well, I helped my cousin buy a house. I didn't really own the house. I was on the mortgage, but I was never owned it. And, and then you got to help those people. Right. And so it's just this whole thing that, it makes it difficult, and puts further strain on first-time home buyers to not really have, any programs directly for them. So, and with that said, there really aren't any, at least here in the state of California.
So Jeb, USDA loans are good for first-time home buyers. If you're in a rural area, if you're in a rural area, look into USDA loans.
Are you considered rural still, or where you are? You're rural, right? Yeah,
I'm rural. I'm rural. I'm as rural as you get. I got chickens outside my neighborhood and goats. You can hear the roosters in the morning.
Yeah.
And that's no lie.
I believe you. Josh, what were you saying?
What I was going to say is you're saying that we can't, discriminate or leave anyone out, but Cal HFA absolutely wanted to do that. Here's a quote from them on the program. It says, we'd like to do something we're not allowed to do in California, and that is not the fault of Cal HFA or anybody else, said Micah Weinberg, chief executive at California Forward, a nonprofit hired by the state treasurer to create a framework for the program. When those of us outside of government talked about what the intention of the program is, it is to very specifically target those demographic communities, African Americans and others, who have been locked out of the homebuyer marketplace for a variety of reasons. You can't actually do that in California. You actually can't do that in the United States. We don't discriminate against people. We don't discriminate for people. We certainly could put better restrictions on it. It was an awful program. It truly was. And we all knew that before they rolled it out. And it kept the money from getting to those, including African Americans, Hispanic borrowers. But the people that needed it weren't necessarily the ones that got it, and the numbers bear that out. Most of the people.
Wasn't this the Wells Fargo thing? The Wells Fargo did this kind of weird loan type thing too, didn't they?
The California Housing and Finance Agency did a 20% down shared appreciation, where you would give back 20% of your appreciation when you sell. We had $300 million. They went through it in 9 days.
Yeah, I think
this just happened. This is crazy.
Wells Fargo had a weird program similar to this that was, to help minorities and stuff, but then it was discriminatory because it only helped one group of people, and then they were we didn't mean it like that. Let me change the verbiage really quick, and then they changed it out.
Yeah, no, I do remember that, and I don't know whatever happened to that. But
they tucked it away because they screwed up when they.
I think I did a video on that. And it's yeah. And now I don't remember what it was. Andrew is asking to comment and reflect on Temecula Murrieta house prices here in Southern California. So it's a little bit outside of my market. Don't follow it closely enough to be able to give you any real data on it. What I will say is that here in Southern California, we're still seeing a lack of inventory in Orange County, in San Diego County, in Riverside, San Bernardino County, historically speaking. So, if a home is priced correctly, it's still selling relatively fast. You're not seeing appreciation in a lot of properties out there. You're seeing more of a stabilization in prices, which is a good thing. And I think that's probably, in my opinion, what you're going to see going forward, just because I don't know that interest rates are going to change very much in the next 3 to 6 months. I mean, I know a lot of people are saying May 10th is kind of the day where you start to see, interest rates move down. That's kind of the talk out there in the industry, because that's when you're going to see, shelter and rental inflation come down. That's going to reflect in the numbers, should give the Fed some reason to pause and whatever, or you're going to see a bigger drop in CPI. I just don't think rates are going to move very far. Therefore, housing affordability is one of those things that, is really driving prices. So I think we're kind of in this lull in the market for an extended period of time, which means you're not going to see big increases, but you're also not going to see big decreases either. But
I have a question really
yeah,
quick.
let's hear it.
So you're like, what I'm seeing, because I talk to everybody around the country, is that like the higher end homes are taking the biggest price reductions, but anything that would be the starter home in that specific area, they're still having bidding wars. Is that common in your area as well? The lowest priced homes are still having amazing, ridiculous traffic on them.
Yeah, yes, but it's weird in what I say. Like, I did a video today that's going to get published, in fact, on Monday, and talking about California. And if you look at our market here, just take Southern California, Orange County, for example, that I don't remember the specific numbers, but nearly 30% of the available listings. So Orange County, as of today, we have just over 2,000 homes on the market. 36% of those homes on the market are under $1 million. Okay. Out of the demand that's on the market, 56% of the demand of buyers at the moment are swallowing up that 30% of homes. So you've got the greater majority, over half of people looking to buy a home, looking to buy under $1 million. So when you say lower priced homes, here where we are, a lower priced home is a home that's 500,000, 600,000
right, but they're
for a
the
condo.
lowest priced for that specific area would be the hottest.
Yeah,
like,
and so those homes are still
here
moving.
Too. Everywhere I talk to says that the higher end homes are taking the biggest hit. Those homes that we could be considered starter for that specific area, anything below whatever the medium price is hot with bidding more still.
Yeah, and so if you factor in homes above $2 million right here where we are, they're still selling. They're selling every day. But you just got less people in general that can afford a home of that price. Plus you factor in, rates going up, which further affects housing affordability. You just got less people that can even buy those homes to start with. Therefore, those are the homes that will suffer the most. But they also, if you price in those homes, 30% of the market is homes above $2 million. So that's not real inventory for most people out there. So when I quote inventory being 2,000 homes, well, once you back out the homes that most people can't even look at, you don't really have much inventory at all. And that's why, like you're seeing and saying, is that you're seeing multiple offers. You're seeing people offer above the asking price because you've got all of this demand vying for very few homes at the end of the day.
So in Boise, Idaho, I had an agent on my channel that was from there. And, that's one of those markets that was the first to get hit with it's crashing, it's crashing. And I actually had her pull up the numbers from her MLS that showed the houses that were the most expensive in the area were taking the biggest price reductions. But those houses that would be affordable for her area, which were under 300,000, there was only 4 houses available. Yeah. And they'd only been on the market for a few days, and they were showing all the pendings, and anything that was under 300,000 was pending within days, like 1 or 2 days. I mean,
you want to tell
anything below that medium price in any area is still flying off the market.
Well, for us here in Huntington, the number is probably 1.2. But Jeb, you had a client that was qualified up to $1 million. And how many homes, single family homes, were available for them in the entire city of Huntington Beach?
I think there were like 5, but then once you took out, one was a house that had been on fire and needed a complete rebuild. So it wasn't a financeable house to begin with. It was it was almost $1 million, but it needed to be a cash offer. And then it was going to require probably $1 million to rebuild it, interior wise. So that's not even a real property. One was a house that they priced low to get offers on. So that wasn't really, so it ended up being like 3 properties in all of Huntington Beach. It was under $1 million. So, I mean, it's crazy.
Your market is not anything like ours.
Nah.
Nothing. Before the pandemic, 200,000, we'd get you a house with like, that was built maybe 10 years ago, 1,600 square feet with a yard.
And what would that rent for?
Rent for about $1,600.
Pretty good.
Yeah. We have a rental around the corner. I could raise it to $1,600 right now, but I won't. My renters have been there for 2 years and they've paid on time, even during the pandemic. I'm keeping them there. I'm not raising them.
Look at that. Christina coming in with the win. Good person all the way around.
I like me a lot. You know?
We like you too. So welcome.
Every day I give myself a little hug and I'm like, God, you're awesome. I'm like, thank you.
Josh, I think you kind of look like you had a question, but I'm going to throw this up there. And if you do, you can ask it or say it or whatever. But
no, this question was where I was going. We got a couple of,
because I think we can both talk
questions.
to this in 2 different markets, right? So we're here in Southern California. Christina's in Southern Louisiana, but is it worth to build an ADU? Let's just say with that, cash doesn't matter. Cash finance, I don't really care how you build it, but is it worth to build an ADU? So why don't we start with Christina and get her thoughts? Because in fact, she's sitting in a quasi ADU at the moment. But yeah, what are your thoughts?
Yeah, I think they're worth it. I definitely think they're worth it. They do add to your appraised value to your home, especially with the type of improvements that you put in the area. If you have an affordability problem in your area, an ADU is going to do nothing but bring up that value even more. And likability, sellability, it also increases that. The thing I've noticed though with ADUs in California, you really need to price them out because they have really upped those prices to the point where I'm not even sure if it's worth it. I don't know because I don't do that market, but I've had people come to me, like companies like ADUs, and they want me to show them. And I'm like, this isn't affordable. This is a $300,000 house behind a house. This makes no sense. So I don't know. But here in Louisiana, with the type of ADUs we have, they're 40 to 60 to 100,000. Yeah, they're absolutely worth it. 100%. You'll get all of your money back plus some.
Yeah, and I've talked about this on the show before. ADUs here in Southern California, because when you're building an ADU or trying to determine the value of what an ADU is going to add, it's really hard to find something that has one, right? Comparable wise, and it's really hard in the MLS to search something that has an ADU because there's not really an easy way to do it. So there's not really, a way to find out which homes have them, which homes don't, what kind of value it adds. So that part is tough. But what I will say is in California, larger lots, typically are more susceptible to building ADUs and creating value on those lots. So I think they do add value. Hard to say, if it costs you $100,000 to build an ADU, is your home worth $100,000 more? I don't know. I think in some markets, the answer is yes. In some markets, the answer is absolutely not. But what you see here a lot in California is people building an ADU, turning around and renting that ADU out. So, now you're getting an additional $1,000, $1,500 a month, and maybe you got a HELOC, and that $100,000 that you borrowed is costing you $600 or $700 a month. Josh, you could speak to that. What the value of money, how it relates to pulling cash out. But if you can then turn it around and rent it for $1,000, $1,500, and your positive cash flow, then you start to think, okay, there's other opportunities here, and whether or not it makes sense.
I want to give an investor tip though, because I have a house that has a house behind it with an ADU behind it. And if you have a house that you are doing this with, make sure that you have the right permitting for that, because when you go to refinance it, And if the house is attached to the ADU in any way, shape, or form, they may not be able to refinance your house. Or if it isn't connected, they may not be able to refinance that house. If you have two separate meters on each one of the house, it could become a problem. So be very careful before you decide to do this and you're going to rent it out. And then you decide later on you're going to refinance, you're going to have a huge headache. And that also goes for the homeowner's insurance as well. So always investigate that ahead of time.
There you go. And Josh, we got a question. What's an ADU?
An accessory dwelling unit. So limited zoning laws and regulations limiting you from doing that. It's putting another property on your property. As Christina said, you can build them attached, you can build them detached. Sometimes they're prefab, modular, come in a million different shapes and sizes, but it's basically another dwelling unit on your property.
Yeah, and you have Arnold coming in with a comment basically saying $160,000 for a 500 to 600 square foot addition, 300 to 400,000 for 1,200 square feet. So, and I don't know that those numbers are accurate, but they don't seem that. I mean, they are crazy, but based on
in California,
what I know,
it doesn't seem unreasonable.
It doesn't seem that unreasonable. Or it seems unreasonable. It just doesn't seem that crazy when those numbers are reported. So. Hopefully that is helpful. Let's see here, Josh.
Hold on,
we got dogs. We got dogs going on. Christina,
Jeb, this is a quick and easy
on?
one, and I like this. There's some good information here. So
Yeah.
hashtag Chance says, I have no debt and 60,000 liquid. Should I pay off the remaining 3,000 I owe on a vehicle, my only debt, or should I pay off as planned, considering I would pay off a few months short of the home purchase? So he's pointing out that it'll be paid off before he finishes the home purchase, so it's not going to impact his qualifying and his debt to income ratio. Follows up with, I mentioned it because of the credit drop right before the home purchase. Generally, paying off installment debt like an auto loan, a student loan, a consolidation loan, any type of personal loan, it's going to have almost no impact on your credit score, good or bad. So I wouldn't worry about it. To me, $3,000 that I'm going to pay off in 4, 5, 6 months, it's a nuisance. You have the money sitting in the bank, just be done with it. But it's really personal preference. You can pay it out or pay it off, but I wouldn't worry about it having any adverse impact on your credit score and your qualifying.
All right, Josh, I realize this is a comment, but I want to ask a question from the comment that's coming here. It says, I'm late. I just want to share that lending is tightening. I had an interview with a lender today, and I was requested a list of documents that never before were requested, like my 401k statement. So ignore the second part of the question. I want to ask, are you seeing any current tightening in lending standards with regards to buying a home?
The vast majority of loans in the United States go to Fannie, Freddie, FHA, VA, USDA. There's been zero impact, no changes, no differences in the guidelines. Now, investors that buy those loans can make overlays. I have seen no additional overlays. So the reality is absolutely no change on that front. Where have we seen some changes? Non-QM loans, jumbo loans that are generally financed by banks, that they keep them on their books and or in the secondary markets and have a little bit of risk. We've seen a little bit of change there, not significant. Where you're seeing lending tightening standards tighten is in commercial real estate. Commercial credit is much tighter, and you're seeing big reports of them tightening things up from that end. But in the residential, I think most likely that listener there just came across a loan officer who's sort of more comprehensive in the way they want to do a pre-approval. Because if you're looking for a standard Fannie, Freddie, FHA, VA deal, zero difference in underwriting guidelines versus 2-3 months ago.
All right,
is it tightening now? I have a question though. I gotta ask.
Yeah. Let's hear it.
Is it tightening for commercial because of the fact that there's been so many companies that have had like more layoffs, and that there's been like more companies that have been having employees that were working from home? Is it like there's uncertainty in the commercial market, so that's why they're creating this tightening of it?
That uncertainty impacts the collateral, but the actual lenders are 70% of commercial loans are done by small to mid-sized banks.
Right.
Those are the ones that the Fed said, hey, they may not be systemically important, so they may not get a bailout like Silicon Valley Bank. So they make the loans. They've been told you're not going to get a bailout. Their cost of funds are through the roof, and they're having a hard time getting a margin on it that makes sense. A friend of mine was in a meeting with the heads of 8 or 10 credit unions here in California. And they were just basically explaining, like, we don't want any mortgages right now. A year ago, they were out saying, how can we expand our footprint? How can we bring more mortgages in the door? They're saying our cost of funds is so high. We have no portfolio runoff. No one is selling and paying off. No one is refinancing. So we have all of these loans that are not running off, and the ones that are getting put on the books, we can't make any profit off of them because our cost of funds is high. So same thing in that commercial space. There's just very little profit, and the collateral is dicey when you're talking about office buildings and retail space. Other things not as bad, but really that office space for the reasons you mentioned, retail space because of the shift to online shopping.
Yeah. And as Josh mentioned, I mean, didn't really touch on there, but something we've talked about before is because of people working from home, right? Not going into the office, a lot of this office space is no longer being used. And, and what happens is, commercial loans, a lot of them are 3, 5, 7-year loans. They're not fixed rate loans. And so what happens is when they go to buy a building, refinance a building, how much the bank lends them, a lot, and the terms depend on the occupancy rate of that building, what kind of income that building is bringing in, all of those factors. And so when you have vacancies, when you have, people not renting new space or not re-signing leases for whatever reason, those numbers go down. And therefore, when it's time to refinance this 3 or 5-year loan with the bank looks at it and goes, we don't want this on our books. And therefore you've got additional issues happening in commercial, which a lot of people believe is possibly the next quote unquote shoe to drop here in the next 3 to 5 years. So it'll be interesting nonetheless.
That's why malls fail.
Yeah.
That's it. Like, that was like when you were explaining all that, I'm like, that's exactly what happens with a mall. They have all this space, not enough people renting it out, then a mall falls apart.
Yeah. And it becomes housing in some, I mean, is that what they're doing here at the Westminster Mall? Josh, did I see a thing that is now possibly looking to be housing? Are you frozen, Josh? What's going on?
He looks very frozen.
He does look frozen. Are you frozen?
Now he's blinking.
We froze there for a second. I'm back now. I'm alive.
All right. Nevertheless, we'll just move along. I have a question here for Christina. We're wrapping up the show here, but it's a question I can't really answer. So I'm going to throw it your way. Pros and cons of building a tiny home on wheels versus no wheels. So let's just talk. You don't need to necessarily go pros and cons, but does it make sense to put wheels on a tiny home versus a permanent foundation?
Okay. So it depends on what you're using it for. If you're planning on taking it, around the country, then yeah, you're going to want it on wheels. But if you're thinking that you're just going to park it in your backyard and use it as like a secondary dwelling to your house, or maybe like a granny flat, that type of thing, you may have run into some issues with insurance and your HOA. So there's, you're going to have to deal with that, because some neighbors will be like, that can't be in the backyard. And they're going to be calling your HOA all the time. You'll get fines. Now, if you have an HOA that allows for RVs, make sure the tiny home has an RV specification to it with the licensure that you can show the HOA so they can't make you move it. That is a loophole that people don't know about. So I just want to let you know, if you're thinking about doing that and your HOA does allow for tiny homes on wheels, get the one, allows for RVs in your parking, just make sure you have get the tiny home that is RV certification. I personally, if you're looking for it as a second home, so you can have it insured and not have the problem with insurance. That's the biggest thing that comes up with tiny homes. Is it like nearly impossible to get insurance on a tiny home that's either on wheels or under like 600 square feet, so like, just know that ahead of time. But if you have a full poured foundation and you have it all like wired and up to code for the area, you're going to have a lot easier time getting homeowners insurance or connected to your homeowners insurance with that little house that's connected on a slab.
Good stuff. So tonight we had an impromptu guest, Miss Christina Smallhorn here. Yeah, unscheduled. If you're not familiar with Christina, go check out her YouTube channel. Again, provides a lot of value, a lot of the things that we've discussed tonight. As I mentioned earlier, she can elaborate a little bit, but affordable housing, tiny homes, manufactured, mobile, all of that good stuff. Kind of an expert in that, land, all of that good stuff that I have no idea anything about. So head on over there, check out her channel. As always, we have Mr. Josh Lewis here. Josh, anything you would like to say before we part tonight? We're going to give it to Christina to end.
Let her have it to end. I want to answer a question because it's like that important. Yes. Gerald Grant says, thanks for all the information. I'm in the process of buying a 2-unit home for $1,150,000 with negative cash flow of $1,500 a month. I have the money, but it's a high amount. The answer is don't. We had Michael Zuber on a few weeks back on the podcast, and what does he call it? Feeding the alligator? Don't buy alligators. Like, don't.
Right.
It doesn't matter. Today, you might have a spare $1,500 a month, but that's a cheap Lamborghini. It's not a really high-end Lamborghini.
You ain't buying a Lamborghini for $1,500 bucks a month.
No, $1,500. I'm aging myself. In the 90s, you could absolutely get a Lamborghini for $1,500 a month. But long way of saying $1,500 bucks is real money. And what are you getting for it? So some of the mortgage is going towards principal. You're paying it down. You're hoping to get some appreciation, but I would never buy anything with negative $1,500 cash flow. There's lots of things you can do with $1,150,000 that will bring you positive cash flow, unless it's just some absolute trophy.
Yeah, unless the rents are not to market, unless there's some sort of value add that you can do to that property to get it, to be able to increase the rents that you no longer have that $1,500. Unless you know something about that property that's going to increase the value to a point where it makes sense to be able to carry that negative cash flow. I mean, you're talking what, $18,000 a year in negative there. It could be a write-off. It could be other things depending on, your tax bracket and all of these, different things. But for just looking at it from what you've said, I don't know that it makes sense. But either way, we appreciate you being here. We appreciate the question. So if you've found any value tonight, hit the thumbs up. Check us out on the podcast, The Educated Home Buyer. Again, trying to provide value there. And we do that with your questions, with you guys following up, constantly being here. So we appreciate that. Christina, we are going to leave it to you tonight to tell these people whatever you would like to say.
Well, I'm going to give myself a selfish plug. If you're a real estate agent
Yep.
and you want to learn how to build up
good.
your YouTube channel, I actually have started a course. It's a Real Estate Video Geeks. And if you're interested, go ahead and hit me up. I will help you build your YouTube channel. And as a matter of fact, every once in a blue moon, Jeb even asks for my advice.
I do. And Christina has helped me tremendously. So I will say that she truly knows what she's talking about. In fact, I was going to ask you, is there an affiliate link for that course? I meant to text you the other day.
Not yet.
Okay.
Not yet, because we still haven't discounted. It's way undervalued right now. Like because we're in the beta testing stage. So we want to make sure it's like completely streamlined. So it's at a massive discount.
I'm happy to still send people your way. I just didn't know the answer. So
yeah.
Jeb won't tell me anything about growing a YouTube channel. So maybe I'll just pay you since he doesn't like me.
Yeah, right.
Join the Real Estate Video Geeks. You know that Daryl Eves is on there too. Daryl Eves, Joe Eves, and myself. It's huge. It's a massive course.
So good stuff. I think she's trying to push me to go over there and buy this whole thing.
I do.
Yeah, maybe I need that. Either way, guys, we appreciate you listening. We appreciate the support. Until next time, adios. Josh?
And via con Dios. I almost